Welcome back to another video here at FiscalVoyage. I'm Felix. Before we get started with today's stock analysis, I have a free ebook in the description. Make sure to check that out. So in the description, there's a link to a free ebook. In this video, we're going to talk about a real estate investment trust, a REIT. This video was suggested by Alan. Alan wanted me to do some a stock analysis on a REIT. So this video is for you, Alan. Thank you for supporting my channel and always commenting and watching my videos. I really appreciate it. So we're going to do a stock analysis on Store. We're going to determine the fair price of the company, and I'm going to provide a recommendation. So if this is your first time visiting my channel, make sure to hit that subscribe button for more videos like this. Okay, Store Capital Corporation, ticker symbol STOR. The company is a internally managed net lease real estate investment trust, or REIT, and is a leader in acquisition, investment, and management of single tenant operational real estate. And that's what actually STOR stands for, single tenant operational real estate. So let's look at the fundamentals from the company. In 2012 to 2019, because the company is fairly new, so they only have public information from 2012 to 2019. So, but in that time period, revenue grew at an outstanding rate of almost 50%, 48.9%. Net income grew even higher at 66.6% in that same 10-year period. And currently, the company has a credit rating of BBB, which is investment grade, which is great. And operating income at 53.4% growth rate in this period. And free cash flow, since it's a REIT, we look at free cash flow. So free cash flow per share growth at 7.5%. So it's not as great as the revenue and net income, but it's a very nice, respectable 7.5% growth from 2012 to 2019. However, for the past year over year, from 2018 to 2019, earnings grew at 8%, or free cash flow grew at 8%, so slightly better. And net income in the past 3-year average is at 32.6% and revenue at 21.3%. So it's been coming down, revenue and net income growth, but it's still very, very high, at higher than 20%. Let's continue with the fundamentals. 2019 free cash flow per share came in at $1.99. Net margin at 42.7% versus 2018 of 40.1%. So net margin has improving, and actually trailing 12 months net margin is slightly higher than the 42.7%. So that's positive. Return on equity has been consistent around 6 to 7%. Last year they had return on equity of 6.8%, and currently the company has a great dividend yield of 6.10%, which is real good in this low interest market. So for those investors that's interested in income, this company definitely fits that category. 3-year dividend growth rate at 6%. And currently the company has a very good payout ratio at 74%. This is based on 2020 expected free cash flow, so that's very positive news there. And the company has been growing dividends for the past 5 years since they started, so that's a positive as well. The 5-year dividend yield average is 4.39. So at 6.10%, you're getting a much better dividend yield than the 5-year average. So that's great news there. And the most recent increase came in September of last year at 6.1%. So I'm actually expecting another increase sometime this year. And I'll talk more about the dividends and the rental payments that the company has been receiving shortly. So let's look at the balance sheet. Debt to cap at only 47%, which is good. And current ratio at 6.31, which is great. They have more assets than liability. So that's real good news there. Debt to equity ratio is very respectable, 0.92, so that's good. And interest coverage at basically 3. So their likelihood of not being able to cover the interest is unlikely, so that's positive there. So the balance sheet looks good here based on these metrics. And price to book ratio at only 1.2, which is favorable versus the 5-year average of 1.72. So let's look at future outlook. But before we look at future outlook, let's look at the payments, the dividend, as well as the rent payments in recent months. So as you can see here, Store Capital reports July rent collection of 85%. So this is actually a better increase. As you can see here, the company received 71%, 68%, 78% in April, May, and June. So July report at 85%. So they're improving the rent collection. And as you can see here, the CEO, Christopher Volk, said that based upon the tenant survey we conducted over the past week, we estimate that 92% of our locations are currently open for business. So this is very positive. And when companies or the stores are open for business, they have to pay rent. And paying rent, as you can see here, 85% of rent collection means the dividend is should be very well covered and safe. So let's look at the most recent declaration for the dividend of 35 cents. You can see here is in line with previous, and this was announced in June 15, so it's last month, and payable July 15, so it just passed. So this, during last month they announced the dividend and it was in line. So that's even gives me more certainty that the next dividend announcement is either going to be in line as well or even a raise, because it looks to be very promising. So I think this company's dividend is very safe, as you see here. Okay, future outlook. In 2020, analysts expect free cash flow coming at $1.88. This is lower than the 2019 $1.99. Of course, this is because of the economic shutdown. A lot of the retail location didn't were closed, so some of them, as you saw, weren't paying rents, but now they're catching up, so that's very positive. 2021, they're expected to jump right back up at $1.96. That's positive. And analysts are expecting free cash flow growth of 5%, so that's good news there. So that should be consistent with the dividend growth rate as well, because most REITs, based on free cash flow growth, is how much they tend to pay out. That same growth rate is the same dividend growth rate as well. My dividend yield return model came in at only 7.8% growth, and of course this is mostly from the dividend payment. So I don't see too much capital appreciation from this company, but that dividend is very safe, it looks like, and for income investors who likes real estate investments trust, this looks like a good opportunity. But we'll go over that more shortly. Currently, the price to free cash flow is 12.1, and the forward price to free cash flow is 11.9, which is much better than the 5-year price to cash flow average of 15.4. So that's very positive. So if we look at the fast graph for Store, as you can see here, during the economic shutdown, the company lost a lot. It went down basically 53.3%. Basically in less than 2 months. So that's a drastic drop in price. And when you get a drastic drop in price, there becomes opportunities. And I actually owned some shares of Store, not a whole lot, but I bought it around I think it's $18 or $19. So I'm up now. But as you can see here, the company's 2020 expected earnings at $1.88 versus $1.99 in 2019. It is a 6% drop, of course, because of the economic shutdown, but it's very promising. And you can see the gap between earnings, free cash flow, and the dividend. So it has a good payout. As you can see here, 74% payout based on the 2020 $1.88 free cash flow. And then you can see 2021 is expected to pick up by 4% and then 6% in 2022. So that's very positive news. And you can see here the company tends to follow this free cash flow multiple of 15. So, it was under 15 there, then it went over 15 to up to 19, then it went back down to 15, then it went over 15 up to 20 here, and then obviously the economic shutdown and stuff, it went dropped. And now you get it for price to free cash flow of 12. And so that gives it a very attractive. So if we were to estimate, if all these estimates are correct, we could see a potential 18% annual rate of return going forward until 2022. And I see no reason why this not to continue like this, because the likelihood of another economic shutdown is very unlikely. So I think this company made it through the storm, and it should progress forward currently, current situation. So this is very positive. So let's look at the fair value price for Store. CFRA doesn't give a fair value price. Morningstar at $31.48, FastGraph at $28.35, Yahoo at $27.21, and my dividend discount model analysis at $24.40. I use a 5% dividend growth rate, matches the analyst's expected free cash flow growth rate for the next 3 years, and 4% after that, with a discount rate of 10%. Normally, sometimes with high dividend yield, you like to use a discount rate of 9%, but I'm being a little more conservative. So this is how I use 10% here, and this is how we get $24.40. Averaging out to 4, we get a fair price of $27.80. And currently, the company goes for $22.45. That means it's undervalued by basically 24%. And that undervaluation is very attractive. It meets my criteria of 10% or more for margin of safety. So that's why I have a buy recommendation for Store at today's prices. So as you saw, I have a buy recommendation for this company. I actually own shares of this company. I bought it actually in sometime in early April, so it's much lower price than it is today, but it still presents a great opportunity. As you saw, the dividend looks very safe. They've been collecting rents, and the rent collection has been increasing every month, so that's very positive. And as you saw, revenue growth and net income growth has been outstanding. It slowed down in recent years, and of course, most likely it'll slow down this year, but I'm pretty sure it'll pick up by the end of this year and then the following year and the year after that. It's a company that I definitely recommend you checking out. Again, remember, just because I have a buy recommendation doesn't mean go out and buy it. Go out and research the company. I think it's worthy of your time for further research. So that's what my recommendation means. So spend the time, research the company, look at their financials, look at their current quarterly earnings, the annual earnings, and things of that nature. So I hope you enjoyed the video. Thank you for watching. Again, if you're new to the channel, make sure you hit that subscribe button. And remember, I have that free ebook in the description, so make sure to check that out. Thank you, and I'll see you guys in the next one.